All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, Greg Magadini, fan favorite and director of derivatives at Amberdata. Greg, how you doing?
Doing well. Thanks for having me on again, Ryan.
Absolutely. It's a pleasure to have you on this show. I think everybody in the YouTube chat enjoys it as well. And so if you're not streaming on YouTube, get over there, type some crazy shit into the chat, or maybe more appropriately, if you have a question for Greg, maybe ask in the chat. We're going to go everywhere here today and really focus on some options, trade ideas, if you will, in crypto, not necessarily just in crypto, but also in some of the recent IPOs and other stocks that you can trade here as well. So excited to have you on the show as always, Greg. Let's just get into it. We've had Bitcoin chopping around a little bit, I suppose is how you would describe it. Took a peak below 100 real quick and right back here to, well, I've got 107 on the screen at the moment, but about 108 or so, kind of flirting with those prior all-time highs. What do you make of the resiliency of Bitcoin here? There's still a little bit of a positive correlation when you look at this across assets, specifically equities. You've got just massive geopolitical risk on the rise, and maybe that arguably has been somewhat subdued recently. But typically, you'd look at what's going on and you'd think, okay, risk assets are going to be lower. Bitcoin's going to be lower at a higher volatility. And yet, maybe it doesn't matter. What do you think?
Yeah, I always view Bitcoin as half kind of risk-off, digital gold sort of behavior, and then other half is kind of the risk-on trade. Ethereum, I view clearly more as the risk-on trade. But I think overall what we're seeing in Bitcoin right now is just a steady trend higher, kind of the low volatility grind higher, which in my mind is a very constructive type of market. It isn't a wild spike higher that gets faded all the way back down a couple months later. It's more of like this constructive, call it 2010 to 2012 sort of bull market, low volatility that we saw in the indices coming out of the recession. So I think this is all constructive. The fact that prices quickly bounced off that 100K level, which is a psychological level that a lot of people look at, is also constructive. And I think this sort of maturity of the asset class or the asset of Bitcoin itself coincides with that lower volatility. So to me, the trend is unbroken here. It's only reaffirmed. If I look at the chart, it looks like a strong trend. And if I look at volatility, unfortunately, volatility for vol buyers has been realized has been underperforming implied consistently here.
Yeah, we're continuing to see implied kind of leak lower here as well. I mean, do you think, and we've talked about this a little bit on prior shows, do you think that's a function of some of these new participants that are coming in and overwriting calls against positions? You have a lot of participation in the ETFs. You obviously have much bigger participants as well that could result in some dampened volatility just given how they, I guess, behave in the market. But what do you think, I suppose, is behind the fact that we're at a yearly low or near a yearly low in Bitcoin implied volatility? And for context for everybody, that's going to be right around 40%. I think I saw 38% depending on how you measure it on a 30-day basis. But, the other side of that, you could be back at 60%. So volatility is very low. What do you think is driving it lower here?
Yeah, I think it's maturing of the asset class. So if you think about Bitcoin volatility a couple of years back, or Q4 2020 when we finally broke above 10K all the way up to 36K, the participant base back then was more retail focused, and so you had a lot more of this sort of FOMO market that you see in some of the Wall Street bet names or the meme stock names, and you had a smaller market cap. So back then the market cap was a fourth of what it is now, if less than that, if not less than that. So it takes less money to move it around. Now we have a couple $1 trillion of market cap in Bitcoin. It just takes more money to move it around. And as you pointed out, we have a different investor base. We don't have the FOMO investor base that we would have with just pure retail. We have sort of this institutional investor base as well, which, like you said, their typical trading flows are buy the asset, sell the call against it for yield, maybe buy a put for protection. All of those things are volatility dampening effects.
Yeah, your, I don't know if I'd go so far as to say nation states, but maybe sovereign wealth funds that are possibly starting to participate are going to act a little bit differently than me, just smashing the button, of course. We have a lot of people already in the chat talking about different trade ideas here, some of the different instruments, mentioning, of course, the Amberdata newsletter that you put out. And I believe you do that on a weekly basis. So everybody should go and sign up for that if they haven't. I want to hit on something that you spent some time on in the newsletter recently, and that's the Circle IPO. You had 5 or 6 points around this. I think you have a really interesting view here. Can you talk us through the Circle IPO and maybe some related trade ideas, given stable coins are just about everywhere right now? It seems like we've got legislation that's making its way through Congress, bipartisan support. Presumably, this is going to lead to more crypto adoption. But Circle is one of the few companies that you can invest in, or at least few U.S. companies that are publicly traded. Just went public recently, to the moon, essentially. How are you thinking about it, and where do you think we go from here? Is this just IPO hype, or does this have legs?
Yeah, I do not think it's just IPO hype. It's very tempting to say that because, the price has rallied so much so fast. But to me, I think this IPO was just priced low. And so how I think about Circle valuation is, instead of looking at Circle as a company, I'll compare the market cap to other cryptos. So, the Circle valuation market cap today is around 50 billion, despite the massive rally we've done. If we look at Ethereum, that's about 300 billion. If we look at XRP, that's about 125 billion. The reason I look at those names is that Ethereum, again, is more of that Web3 play, while Web3 is very highly correlated to Circle or stablecoin usage. We're thinking about DEXs, we're thinking about decentralized applications. A lot of the payment mechanisms are in stablecoins on those products. And then if we look at XRP, that's kind of more of a pure play sort of payment value proposition. And again, XRP is trading almost 2.5 times the valuation of Circle. And Circle is chain agnostic. So USDC lives on Solana, it lives on Ethereum, it lives on Tron, it lives on Sui, all these major blockchains. Well, if I'm making a bet on Web3, I kind of view stablecoins as half of the equation. So that almost, to me, the proper valuation is comparable blockchains. And so if we were going to have Circle be equal to Ethereum, that's 300 billion versus 50 billion, there's a lot of room for Circle to run up from here. And that's against one blockchain, admittedly the second biggest, but still one blockchain. And then if we expand out of that, I do view Circle as more than just a Web3 play. I also view it as cash in the Web2 world. Think about buying things on eBay or on Amazon and things like that. I definitely think that that's going to be a future addressable market for USDC. And then the last kind of point here is that the main competitor of Circle is Tether, and Tether is about twice the size of Circle right now in terms of outstanding stablecoin. But the way that the Genius bill is written is actually kind of building a moat around USDC. USDC is already compliant, they're already audited, they already have one-to-one proven reserves, and then they are also barred from paying out interest to USDC holders. So that essentially kind of preserves their income from being invested in US Treasuries. And then last point here, I know I'm speaking a lot, but last point is that the US Treasury funding mechanism, the fact that Circle is essentially buying short-term paper, that makes it a partnership with the federal government, so to speak. And if we look at outstanding Treasury bills today, it's about $7.5 trillion. So outstanding USDC is 60 billion. So in my mind, there's a lot of room to grow, and it's one of those things that no one can predict how big it can get.
Yeah, I would think, at a minimum, right, you have stablecoin aggregate market cap at, let's say, about 250 billion here today. That's at an all-time high, and that's across all chains and all stablecoins. And as you mentioned, Tether is the largest. I think, if you look at it from the Tether market cap dominance perspective, it's 60, 70%, somewhere around there. So possibly you'll see USDC grow. But let's just say that we go from 250 billion to $1 trillion by the end of the decade. I don't think that that's unreasonable. And what you've described here, I wasn't really thinking about it in terms of that two-pronged approach, because obviously on one hand, makes a ton of sense that if you believe DeFi is going to grow, well, that's a function of stablecoin growth and vice versa. And then also, This is a superior funding mechanism. We're about to launch stablecoin funding, both deposits and then also withdrawals on the tastytrade broker side of things. Again, superior funding mechanism. And I think you're going to see everybody follow suit once things are in place here from the kind of more regulatory side of things. But I'm curious, do you think that the first mover advantage, or let's consider both Tether and USDC as the first mover here, they've been around the longest, they have the largest adoption. How important is that, or how relevant is it in a world where you likely could see, I would think, a JP Morgan launch a stable coin, or you would have competition from a lot of legacy financial services providers here, given there's a framework, and they've probably just been waiting for that over the last couple of years. I mean, how important is that first mover advantage in your opinion?
Yeah, so I think in terms of the Web3 world, Tether and Circle definitely have a strong first mover advantage, and it's a lot easier for them to protect that. They're already integrated in all the exchanges, all the DeFi applications and things like that. The Web2 world, like stablecoin payments, buying stuff on eBay, things like that, I think that's where new entrants will have more of a competitive advantage, such as JP Morgan and stuff, and maybe Visa or MasterCard or whatever it is. I think they'll have a stronger advantage there. But let's see how it plays out. I definitely think the Web3 sort of stronghold, it's going to be hard to dislodge Tether and Circle from there, but I do think Circle is going to dislodge Tether because they have a first mover advantage on regulatory compliance.
It's a great point. I think when you look at the market today, there really isn't any evidence of other stable coins that have come out really eating into USDC's market cap or Tether. PayPal has a stable coin, but does it matter? Maybe it will in the future, but certainly isn't used in DeFi, in my opinion. So
that's right.
That said, Greg, how are you thinking about a trading opportunity here, the setup? I'm looking at a chart here. I've got the last few weeks since the IPO. Maybe I can get down to a daily, a little bit better view. Or no, I guess it's only been around for a couple days. Let's see. Here we go. Okay. Got to zoom out a little bit. First day with my new hands, as we like to say. But basically went public at $60, ran to $300, and inevitably we've seen a little bit of profit taking here. How do you think about price action in something like this? Volatility's through the roof, pretty juicy option premiums from what I can see. If I jump over to the option chain, we'll just open up the July expiration here. $200 underlying, and the at the money calls are 10% of the price. How are you thinking about a trade setup here?
Yep. So first, I want to talk about the source of the volatility. So there's two types of kind of fundamental valuations that create volatility. One is sort of a junk stock that gets squeezed higher and it will eventually just crash back down. So that's one bucket. The other bucket in my mind is something that was underpriced that just ramps up to more of an equilibrium level. I think that's where Circle is. So I don't expect a pump and dump, so to speak, scheme with Circle. I view it as a legitimate equity. Now, the way that I like to think about that is I actually do want to own the stock, and I don't want to chase it here and essentially buy the highs. So I think really selling that cash secure put is a very interesting way to get some action here. If we look at the implied volatility, I have a term structure on Monday. I could see the 42 days till expiration about 180 vol, and then today it's at about 100 and call it 30 vol-ish. So we've come down almost 50 vol points, and that makes sense. A lot of the volatility was built on the way up, and as prices are kind of pulling back, you get that vol crush. So selling that put has some sort of built-in protection in it. If you change your mind and you want to take the position off, you sold vol at high levels, and as prices went against you, the vol went in your favor. So to me, that's a nice, interesting type of trade. It's very forgiving in the sense that if you change your mind, you could probably take it off. And if you really want to own the stock, then you get to buy the stock at a cheaper level, and sort of the return rate, like you mentioned, the July expiration paying you 10% at the money on the cash secured valuation. That's a pretty high rate of return if you're willing to take the stock. So either you get a great premium or you get the stock at a cheaper price. So to me, it's essentially a win-win.
Yeah, I love this strategy in IBIT. And in the event that, let's say, you do take assignment of the shares, the options exercised, you want to sell a call against it, you can do that. Or if you'd like to, with really little impact to your margin requirement or your buying power, you can turn this into a strangle once you have the put on, if you get a little bit of that movement, if that's what you decide to do. A question everybody then has around the trade setup is always, okay, makes sense. What expiration are you focused on in terms of what you see with the term structure? And then how do you think about it on a per strike basis, whether that's in implied volatility terms, or what delta would you look at to possibly sell when you're actually going in there to set up the cash secured put?
Yep. When I trade cash secured puts, I usually stop looking at it as a pure vol type of trade, and I look at it more as a return on locked up cash, like the interest earned, so to speak, setup framework. So that's kind of how I look at it. Obviously, if you do further out of the money strikes, is going to have a lower sort of carry rate or interest rate earned on your cash secure put. And if you go to further expirations, that's also going to be true. It's going to be a lower interest rate. Now, the upside there is that if you get a sign on stock, it's going to be at a better price. So in my mind, it's a little bit of both. Typically what I do, I don't just sell one strike and one expiration. I kind of ladder into it. That minimizes my variance. So instead of being all in one particular cash secure put, I diversify across a few strikes and a few expirations. But I'm not selling anything closer than October. So I'm looking at October, January of next year, and January of 2027. So those are kind of long dated things. I like that because it also makes my income generation a lot more predictable, as opposed to if I sell something very short dated, if fall comes completely down, I don't know I'll be able to sell something that good again.
And I suppose you have a lot of gamma risk on some of that shorter dated stuff too, versus kind of what you're describing here when you think about the theta decay. I mean, a pretty predictable cash flow. Obviously, the stock price can move around a little bit, but I really love how you frame that. And I don't think we talk about this as much on the show when you come at it from the perspective of selling volatility and you think about it as a business, where I have a margin requirement. It's obviously not going to be, depending on what kind of account you have, let's say. But you have a margin account, you're not going to have to put up the full capital. Assuming you do want to take assignment of the stock, you need the money to be able to buy the stock with. But when you think about it in capital efficiency terms, and you compare that then against, let's say, investing that same amount of money in shorter dated treasuries or treasury bills here, you get obviously a much better return here. But for everybody that's following along, you come in here and here's how I would just mathematically size that up, right? We'll just randomly pick a strike. Let's go the 150. I want to sell this, and I can see that I've got, a $12,000 or almost $12,500 buying power requirement here. And I'm going to be taking in, we'll call it $2,400, $2,500 or so in premium. Decent return for, when you think about that risk effectively, if it were to go to zero, that's the investment. That's the capital required to generate that return. Great return for a 114-day period.
100%. Yeah. So that's like a 20% return in 114 days. You're almost looking at 60% annualized. And it gets even better because, you could use treasuries as a collateral. You could be in T-bills, or you also get interest on your cash that you receive up front as well in your brokerage. So there's extra juice to that yield. So to me, that becomes a very interesting type of trade to create a fixed stream of income, and then it's all in my trading account, so I can still trade in my trading account. So I have essentially a draw from these types of trades and structures, and I still get to trade my account for capital appreciation.
Greg, before I let you go, one last thing I want to ask you about Circle here, and appreciate you coming on the show today. A lot of people are obviously familiar with the risk that exists in terms of a stablecoin depegging from the value of the fiat currency. We saw that in, I think, 2023 regional bank crisis, momentary 10% depeg. I don't think you're going to see that as frequently, if at all, going forward with something like Circle. That's my personal opinion. But I'm curious, like, how do you think about the interest rate correlation here? When I look at the fundamentals of the business, it's driven by adoption, but it's a fantastic business in that, given the way the regulations are being structured, they can invest in treasuries and then can't share any of that income with the end user. So the company gets to keep it themselves. People have definitely seen how profitable Tether is, as an example. Do you think that's a risk to this in terms of how you analyze the business, right? Is it really just the interest rate risk here, where if in the event rates went to 50 bips, and I think that would be following some sort of emergency, as we've seen historically. But if that were to occur and you have lower rates, does that make you think any differently about Circle as a company or its valuation?
Yeah, absolutely. Interest rate risk is a big risk for Circle. To me, in context of our portfolio, this is the perfect risk parity trade. Risk parity is when equities go down, fixed income goes up. When fixed income goes up, equities go down. This is a direct inverse correlation between Circle and treasuries. I would structure trades like that. I would own fixed income bonds or fixed income future options or something like that as sort of the upside on rates going lower. And then on the other side of the equation, something like Circle on rates going down. That's a very kind of interesting structure. If I'm just isolating the analysis around Circle, I do think, yes, interest rate sensitivity is something that will affect the equity. But on the flip side, Circle has a lot of levers it hasn't started playing with yet in terms of, redemption or creation fees, for example. There could be something like that. Or wrapping USDC Circle into some sort of RWA convertible type of structure. That can be a fee as well. Or swapping the Circle to a different FX Circle, like so we have Euro Circle versus USD Circle. That can be a fee there, which is cheaper than traditional FX swaps from banks. That can be done in small micro scales. So once the adoption sort of grows, and when we're betting on fiat, USD is the fiat I'd like to bet on. That makes the most sense. I think there's a lot of different levers to pull and push here.
Awesome. Well, Greg, we'll leave it there. This is on my watch list for sure. Probably going to put this trade on myself because I don't have a position in Circle yet. But as always, thank you for coming on the show, man. Appreciate your time. Before we let you go, though, for anybody that wants to sign up for the Amberdata weekly email, you got great thoughts, insights, and trade ideas in there. How do they do that?
Yeah, absolutely. So you can go to our Substack, which is located at amberdataderivatives.substack.com. And here we share our weekly analysis on crypto vol and crypto-related vol equities as well.
Awesome. Well, Greg, thank you again. We will hopefully speak with you here soon, a couple of weeks or so. So tune in for that. We'll let everybody know when Greg's back on the show. But that's going to do it for the Tasty Crypto Show tonight. Victor Jones is up next with the Price of Truth. Until then, I'm Ryan. Peace.